Why are some high-income ETFs becoming a top choice for investors? Well, high-income exchange-traded funds have carved out a significant niche in the investment landscape, appealing to those seeking consistent dividends. These funds offer attractive yields and incorporate strategies to dampen the effects of market volatility, making them a go-to option for investors aiming for both stability and income. One such ETF that has garnered attention is the Simplify Volatility Premium ETF, commonly known as SVOL ETF. So, what's this ETF all about? In this video, we'll delve into the fundamentals of SVOL ETF, its underlying strategies, benefits, and important considerations before investing. So, without much ado, let's get started. Understanding volatility and its effects. What makes the stock market tick, and why does it sometimes seem like it's riding a roller coaster? At the heart of these ups and downs is a concept known as volatility. Volatility measures the rate at which securities prices increase or decrease for a set period. It's a vital indicator for investors, as it reflects the degree of risk or uncertainty about the size of changes in an asset's value. A key player in understanding market volatility is the VIX, the Volatility Index, or the Fear Gauge. The VIX provides a 30-day forecast of volatility based on options trading on the S&P 500 index. When the VIX value raises, it signals increased fear or uncertainty among investors, indicating that volatile market movements are likely. On the other hand, a low VIX value suggests confidence and stability in the market. Most exchange-traded funds are directly affected by market volatility. During periods of high volatility, ETFs, like individual stocks, can experience significant price swings. This can lead to increased risks for investors who might see the value of their investments fluctuate wildly in a short period. However, it's not all doom and gloom. Some investors see volatility as an opportunity to buy assets at a lower price or sell when prices are high. Amidst this volatility, SVOL High Income ETF stands out. Unlike traditional ETFs that may weather the storm, SVOL is designed to thrive in it as it is an actively managed fund. SVOL ETF Overview. You see, as an actively managed ETF, SVOL ETF differs significantly from traditional passive ETFs. While passive ETFs aim to replicate the performance of a specific index, actively managed ETFs are overseen by managers who make investment decisions to outperform a benchmark index. This dynamic approach allows for more flexibility in responding to market changes and opportunities for potentially higher returns. The SVOL ETF utilizes this active management strategy to navigate the complexities of the volatility market, making it a distinct offering in the ETF landscape. The SVOL ETF, also known as the Simplify Volatility Premium ETF, aims to achieve daily investment results that mirror approximately 1/5 to 3/10 the inverse performance of a short-term volatility futures index for a single day. This unique investment goal positions the SVOL ETF as an innovative financial instrument, targeting investors looking to hedge against or capitalize on market volatility through an ETF structure. The fund's daily performance objectives underline its active management strategy, aiming to adjust holdings dynamically to meet its targeted inverse relationship. Understanding the inverse relationship to a volatility futures index is crucial when considering an investment in the SVOL ETF. The ETF aims to move in the opposite direction of the index it tracks, but only daily. For example, if the volatility futures index rises, the SVOL ETF value is designed to decrease, and vice versa. This relationship provides a strategic tool for investors looking to mitigate the effects of volatility in their portfolios. Let's try and understand the underlying strategy used by this ETF. underlying strategy and exposure. The Simplify Volatility Premium ETF employs a range of financial instruments to achieve its investment objective, primarily through futures, contracts, and call and put options on VIX futures. Futures contracts, including those traded on the SVOL platform, involve agreements to buy or sell an asset at a specified price on a future date. In the case of SVOL, these contracts are specifically centered around short-term volatility futures. These instruments enable ETFs to speculate on the future direction of market volatility. Call and put options on VIX futures further provide the ETF with the flexibility to profit from or hedge against changes in the volatility levels, making these derivatives essential to the fund's operations. Collateral is also crucial for the fund's operation. Collateral is used to secure the options arising from the ETF's use of derivatives, such as futures and options. This collateral may consist of cash-like instruments, or high-quality fixed income securities, including U.S. government securities, money market funds, and investment-grade corporate debt. These assets provide a safety net, ensuring the ETF has the means to meet its financial commitments, especially in volatile market conditions. The selection of collateral is strategic, emphasizing liquidity and quality to ensure that the ETF can quickly convert these assets into cash if needed. This liquidity is essential for the fund to respond swiftly to market movements, allowing for the timely adjustment of its derivative positions to maintain the desired inverse relationship with the volatility index. Now, let's have a look at the current status of the SVOL ETF. The Simplify Volatility Premium ETF is an intriguing investment vehicle for those looking to potentially enhance their returns over traditional full-time employment income. By analyzing the key metrics and details extracted from Yahoo Finance, we can gain insights into how an investment in SVOL might perform over time. SVOL has approximately $734.76 million in net assets, indicating a moderately sized fund within the ETF landscape. This larger asset base demonstrates a higher level of investor confidence and participation and enhances the fund's liquidity. Liquidity is crucial for investors as it facilitates easier entry and exit positions within the ETF. A fund of this size is more likely to manage inflows and outflows without adversely impacting the market price, making it a more stable investment choice. The yield of 16.22% is particularly noteworthy. Such a high yield is rare in the ETF landscape and represents a substantial income stream for investors. This yield far exceeds what many traditional employment opportunities could offer, especially when considered as passive income. For an investor putting $50,000 into SVOL, this yield could generate an annual income of approximately $8,110 before accounting for any fund expenses and taxes. With a year-to-date daily total return of 2.21% and a one-year daily total return of 19.95%, SVOL shows promising performance. The substantial one-year return, in particular, highlights the ETF's potential for significant appreciation, contributing to its attractiveness as an investment compared to earning a salary. SVOL's top holdings include the Simplify Aggregate Bond ETF, Simplify Stable Income ETF, and Simplify Tail Risk Strategy ETF, making up 23.47% of its total assets. This diversification within the ETF suggests a strategic balance between risk and return, leveraging different market conditions to potentially enhance overall performance. The fund is relatively new, which provides a relatively short track record. However, its performance indicates a promising future, assuming similar market conditions persist. Considering the ETF's one-year daily total return of 19.95%, a $50,000 investment could have increased to around $59,975 in a single year, assuming similar future performance. This significant potential for appreciation, coupled with the continuous income from the yield, could substantially outpace the earnings from a full-time job. SVOL offers an interesting proposition for investors seeking to diversify their income sources and possibly exceed what they could earn through employment. Its strategic focus on market volatility, a solid performance record, and a reasonable expense ratio of 1.16% make it a noteworthy consideration for those looking to enhance their financial portfolio. However, as with any investment, it's essential to conduct thorough research and consider one's financial situation and risk tolerance before investing. Investing in the SVOL ETF has many benefits, so let's go through a few. First off, it offers a unique avenue for diversification, allowing investors to incorporate an asset into their portfolio that is inherently designed to behave differently from conventional equity and bond investments. This diversification benefit stems from the ETF's focus on volatility, an asset class that offers moves independently or inversely to the broader market. By adding exposure to volatility through SVOL, investors can potentially reduce the overall risk in their portfolios, as the fund's performance may counterbalance losses in other areas during market downturns. The concept of hedging against market downturns is central to the SVOL ETF's appeal, as the fund aims to achieve inverse performance to a short-term volatility futures index. It naturally positions investors to potentially benefit from increases in market volatility. In periods of market stress, where traditional assets like stocks and bonds may lose value, the SVOL ETF is designed to appreciate, providing a buffer to mitigate portfolio losses. This hedging capability is particularly valuable for investors looking to protect their assets against unpredictable market swings. Liquidity and accessibility are other significant benefits of SVOL ETF, mirroring the advantages of ETFs in general. SVOL can be bought and sold throughout the trading day at market prices, just like company shares. This ease of trading enables investors to react quickly to market changes or adjust their exposure to volatility with a level of agility that is not always possible with other types of investments. Then comes the professional management of the SVOL ETF. It adds a layer of expertise to the investment. Unlike passive ETFs that simply track an index, SVOL benefits from the active oversight of experienced fund managers who analyze market conditions, volatility trends, and potential risks. This management team is responsible for making the tactical decisions necessary to align the fund's performance with its inverse volatility objective, adjusting strategies to navigate complex market environments. Now, even with the benefits of this ETF, there are certain things to consider before investing. So let's have a look at that. The Simplify Volatility Premium ETF carries its own risks and volatility, which is inherently tied to its investment strategy in the volatility market. Investors should be acutely aware that while the ETF seeks to provide inverse exposure to short-term volatility futures, this can lead to significant fund value fluctuations. Volatility ETFs, by nature, can experience rapid and large swings in price, especially during periods of market stress or volatility spikes. This level of volatility demands a thorough risk assessment from investors, ensuring their risk tolerance aligns with the potential for abrupt changes in the ETF's value. Market timing when investing in volatility-focused ETFs like SVOL can be particularly challenging. The nature of volatility means that it can spike unexpectedly due to unforeseen events, making it difficult to predict the best entry and exit points. While some may see short-term opportunities in volatility investments, the unpredictable nature of these spikes can lead to significant losses if timed incorrectly. Therefore, a long-term investment approach, Understanding that volatility is cyclical and can provide opportunities for risk management or diversification over time may be more prudent for most investors. The long-term investment approach towards SVOL ETF should also consider the compounding effects of daily rebalancing on performance. Because the ETF aims to achieve its investment objectives on a daily basis, its performance over longer periods can differ significantly from the cumulative return of its benchmark index over the same period. This effect can be particularly pronounced during volatile or trending markets, making it important for investors to consider their investment horizons and how the ETF fits within a long-term investment strategy. Finally, the decision to invest in the SVOL ETF should be made in the context of an investor's overall portfolio strategy and investment goals. Considering how the ETF characteristics align with one's investment objectives, risk tolerance, and financial situation is key to making an informed investment decision. By carefully weighing these considerations, investors can better determine if the SVOL ETF represents a suitable investment for their portfolio, recognizing both the opportunities and challenges of investing in volatility. And there you have it, a deep dive into the SVOL ETF. Would you consider integrating this unique ETF into your investment strategy? We'd love to hear your thoughts, so please leave a comment below. Don't forget to hit the thumbs up if you found this video informative and subscribe to our channel for more insightful content like this.